Picture this, you're looking at your investment account and it's just bleeding red for 4 straight weeks.
Oh, yeah, just a terrible feeling.
Right? It's exhausting. And then out of nowhere, in just one single trading session, the market completely explodes upward.
Just a massive, violent spike.
Exactly. Yeah, bringing in over $130 for every ounce of gold. I mean, it sounds like an action movie script, but that is exactly what just happened.
It really is wild. Welcome to our in-depth market exploration for the morning of June 27th. I'm your host, and I'm joined today by senior market analyst Dr. Khalid Al-Nuaimi to help decode exactly what just happened.
It is great to be here, and we have a lot of ground to cover today.
We absolutely do. But before we get into the charts, just a quick reminder for everyone listening. The analysis we are unpacking today is purely for your reference and education, not strict financial advice.
Right. Always do your own research.
Exactly. And if you find this breakdown helpful in navigating these wild markets, please take a second to like the video, subscribe to our channel, and comment with your views down below. Your engagement really helps us keep these daily explorations going.
It makes a huge difference.
It really does. Okay, let's unpack this market snap. We were looking at global trend analyses, volatility reports, and overnight trading data. And I have to say, the sheer violence of this rebound is just staggering.
Oh, the velocity of the move is what really stands out in the data. I mean, the tension had been building for an entire month of steady sell-offs.
4 weeks of just bleeding.
Right. The market was heavily compressed, pushing prices down to levels we frankly haven't seen in over half a year.
So let's walk through exactly what just went down, because the timeline of this trading session is wild to me. At 7 o'clock in the morning, gold was sitting down in the basement, hovering around $3,965 per ounce.
Basically a 7-month low.
Yeah. And then the buying started, and it just didn't stop. By 7:45 in the evening, the price had surged all the way to $4,095 per ounce.
Which is just a massive vertical climb.
Right. Eventually closing the week at $4,088. That is a $130 leap in a single day. And, silver wasn't sitting on the sidelines either.
Silver rarely does.
It jumped from $55.70 per ounce to a nighttime peak of $59.50, eventually closing at $59.20.
Silver actually moved with even more intensity relative to its price.
Yeah.
Which is pretty typical of its historical behavior during these sudden market reversals.
But here's where I want to push back on the excitement just a little bit. Despite this massive fireworks display of a spike, both of these metals just finished their 4th consecutive week of overall decline.
Yes, the monthly trend is still heavily downward.
Right. So going back to the rubber band analogy, is this snap a genuine new upward bull market? Or is this just what traders call a dead cat bounce? A temporary technical recovery before the price falls right back down the stairs?
Well, looking at the sources, the data points heavily toward a technical recovery. It is a classic relief rally, and it's being fueled by aggressive bottom fishing.
Bottom fishing because it hit that low.
Exactly. Earlier in the week, gold actually dropped below $4,000 per ounce. You have to understand the mechanics of what happens at a psychological floor. Like $4,000.
It's a big round number.
Right. And it isn't just human traders sitting at their desks saying, wow, that looks cheap. Major institutional algorithms are pre-programmed with automatic buy triggers right around those round psychological numbers.
So when the price dips to, say, $3,999, it trips a wire.
It trips a wire. One massive algorithmic buy order executes, which bumps the price up slightly.
Oh, I see.
And that bump triggers the next algorithm's threshold, which triggers the next. Suddenly you have a cascading wall of buying pressure.
Just a domino effect of machines buying?
Exactly. Combine that with retail investors looking for a discount after a month of declines, and you get a $130 explosion. But, and this is key, an algorithmic cascade is not the same thing as a fundamental shift in the broader economy.
Right, so this is a technical bounce, not yet a confirmed new upward trend.
Precisely.
But algorithms and bargain hunters don't just suddenly act in a vacuum, right? There has to be an external trigger. And looking at our sources, the primary spark for this whole event was the United States personal consumption expenditures data for May.
Yes, the PCE report. That was the catalyst.
And it came in exactly at expectations, 4.1%. I find the psychology of this fascinating because inflation didn't plummet.
No, not at all.
We didn't get some miraculously low number. It was just exactly what people expected. Yet because it wasn't hotter than expected, the entire market seemed to throw a massive party.
Well, you have to remember the market had spent weeks pricing in a total disaster. Inflation has been stubborn, and traders were terrified that the personal consumption expenditures report would reveal a sudden spike.
So they were bracing for impact.
Exactly. When the data came in right on target at 4.1%, it was the absence of bad news that caused the surge. The market essentially exhaled.
Wow.
And because inflation met expectations rather than exceeding them, the probability of the Federal Reserve raising interest rates in September dropped. It went from 64% down to 59%.
And because of that tiny, 5% shift in probability, we saw the United States dollar index fall slightly to 101.32.
Right.
And the 10-year Treasury yield dropped to 4.367%. But stop right there, because this is where the logic feels completely broken to me.
How so?
Well, a United States dollar index at 101 and bond yields at 4.3% are still objectively very high.
Oh, absolutely.
It's like celebrating that a patient's fever dropped from 104 degrees to 103 degrees. Yes, it's a little better, but the patient is clearly still sick. Why did such a tiny fractional drop in those yields cause a $130 explosion in the price of gold?
What's fascinating here is that it comes down to the mechanics of opportunity cost for large pools of international capital.
Okay, unpack that for me.
Well, gold is a non-yielding asset. It doesn't pay a monthly dividend, and it doesn't offer an interest rate just for holding it in a vault. So when government bonds are paying high guaranteed interest and the dollar is exceptionally strong, institutional fund managers prefer to hold cash or bonds.
Because they want that yield.
Exactly. The cost of holding gold instead of those bonds is very high.
Right, because they're missing out on that guaranteed 4 or 5% return.
Precisely. However, the moment that 10-year yield drops even a fraction of a percent, the mathematical penalty for holding gold decreases. And there is a secondary mechanism at play with the United States dollar index.
Which is the currency exchange rate, right?
Yes. Since gold is priced in United States dollars globally, a slightly weaker dollar makes gold instantly cheaper for international buyers using other currencies. Their local currency can suddenly buy more ounces of gold.
Oh, that makes total sense.
So, that tiny drop in the fever, as you called it, flipped the mathematical models for overseas buyers and institutional algorithms from hold to buy. That was the exact spark needed to unleash all that pent-up demand at the $4,000 floor.
That makes perfect sense when you map out the actual plumbing of how the money flows. The mathematical threshold was crossed and the buyers just rushed through the door.
Exactly.
But while the United States inflation data provided the immediate spark, our sources make it clear that the broader global landscape is what's keeping this fire contained.
Right.
For instance, we have to look at the energy markets. Oil prices plummeted nearly 10% over the week.
Which is a massive move for oil.
Yeah. West Texas Intermediate dropped to $70.90 per barrel, and Brent crude fell to $76.21 per barrel.
And that energy drop is a crucial piece of the puzzle here.
Yeah.
It's directly tied to the easing of geopolitical tensions between the United States and Iran in the Middle East.
Right, and obviously we are just reporting on the market impacts of these events, impartially.
Of course. But from a pure market perspective, when the risk of supply chain disruption fades, oil prices cool down.
And lower oil prices act like a wet blanket on overall inflation, right? Because literally everything we buy has to be transported, so cheaper fuel means cheaper goods.
That is the exact mechanism. Lower energy costs mean less long-term pressure on inflation, which feeds right back into the narrative that the Federal Reserve might not need to keep hiking interest rates. It gives the central banks breathing room.
Okay, so the United States data sparked the fire, and cooling oil prices are managing the temperature. But then we look across the globe to Asia, and the physical demand for gold is telling a deeply mixed story.
A very fragmented picture right now.
Right. On one hand, India just recorded a gold premium for the first time in 6 weeks. For those who aren't familiar, a premium means local buyers are actually willing to pay more than the baseline international price just to get their hands on the physical metal.
Which is a massive signal of returning physical demand from one of the world's largest consumer markets.
But right next door, demand in China remains surprisingly weak. And if that wasn't confusing enough, here is the part of the analysis that really makes me scratch my head. Major Wall Street institutions, and we're talking heavyweights here like ING, Deutsche Bank, Goldman Sachs, and Bank of America.
Biggest players.
Yeah, they have actually just lowered their gold price forecasts for the rest of 2026.
It looks completely contradictory on the surface. Retail buyers are flooding back in, India is paying a premium, but Wall Street is quietly downgrading its outlook.
Exactly. How do you reconcile this massive disconnect? Main Street is treating this like the buying opportunity of the year, driving the price up $130 in a single day. But the biggest banks on Wall Street are actively lowering their targets? Are they looking at completely different data sets?
They are looking at entirely different time horizons. Institutional models aren't built to react to a single day's algorithmic buying spree. Wall Street is looking at the heavy structural realities of the macro economy.
The big picture.
Right. Yes, the headline inflation number met expectations, but they are deeply concerned about sticky core inflation.
Meaning the structural costs that are incredibly hard to bring down.
Exactly. Energy and food prices bounce around, but things like housing, rent, and core services are remaining stubbornly expensive. On top of that, they see a highly resilient United States labor market.
People are still employed.
People still have jobs, they're still spending, and that keeps the Federal Reserve hawkish, meaning the Fed is likely to keep interest rates high for a longer period to ensure inflation doesn't roar back.
Ah, the higher for longer narrative.
Yes, and Wall Street also sees the sluggish Chinese physical buying and an ongoing lack of demand for gold exchange-traded funds. Because these institutions believe we are trapped in a higher for longer interest rate environment, their long-term mathematical models automatically dial back their gold projections.
I see the divide now. Wall Street is analyzing the overall climate, while the retail traders and algorithms who drove up the price yesterday were just reacting to the daily weather.
That is a very clear way to frame it. The daily jump was an immediate reaction to the personal consumption expenditures report hitting its target. But institutions are pricing in the reality that high interest rates will continue to act like gravity on gold prices for the foreseeable future.
So this tug of war between short-term excitement and long-term caution leads perfectly into the next crucial part of our dive, what you can actually expect the market to do next.
The forecasting side.
Right. Let's break down the short and long-term forecasts from the latest reports. In the short term, the market is expected to be incredibly choppy. The sources indicate that gold is likely to oscillate violently between $4,050 and $4,120 per ounce.
That is a very tight, volatile range.
It really is. If it manages to break through that $4,120 ceiling and actually hold its ground, the rally could expand significantly. But if the United States dollar strengthens again next week, gold could easily lose its footing and fall right back toward that $4,000 floor.
The short-term picture is highly reactive. But looking at the long-term forecast, the overarching bull cycle for gold hasn't been canceled by a 4-week correction.
Good to know.
If you look past the immediate noise, the structural supports are still there. If inflation does eventually cool enough for the Federal Reserve to begin cutting rates, the opportunity cost of holding gold drops, and the asset has tremendous room to run upward.
And we really can't ignore the macro events that exist completely outside of the Fed's control. We are looking at ongoing geopolitical shifts, international trade restructuring, and the potential impacts of President Trump's specific economic and tariff policies.
A lot of moving parts.
Yeah, and obviously, regardless of your political views, we are just looking at the economics here. Major shifts in international trade policy inherently create market uncertainty, and uncertainty has always been rocket fuel for precious metals.
Exactly. The long-term fundamentals supporting gold-like currency devaluation, geopolitical instability, and eventual rate cuts, they have not vanished.
So, to summarize the forecast dynamic clearly for you, the short term is a volatile roller coaster, but the long term is still a slow train steadily heading up the mountain.
That's a great analogy.
But understanding the forecasts is really only half the battle here. The goal of this deep dive is to translate this high-level knowledge into practical, actionable steps for your portfolio right now. We have combed through the strategy recommendations from the analysts, and rule number 1 across the board is absolute discipline.
Absolute discipline.
Do not succumb to the fear of missing out. After watching a $130 jump, the temptation to chase the market is huge. Don't do it. You need to watch the United States dollar index and treasury yields very closely over the next week before making sudden moves.
Discipline is the only defense against volatility. If you are an investor who utilizes dollar cost averaging, your strategy should not change one bit today.
Just ignore the noise.
Completely.
Yeah.
You don't need to try and time this bounce. Keep buying on your regular predetermined schedule. That consistency naturally averages out your purchase price over time and entirely removes the emotional stress of trying to guess if the bottom is truly in.
What about the investors who bought in heavily a month ago? The folks who purchased right at the absolute top of the market and have spent the last 4 weeks watching the value of their holdings slide downward. It's incredibly easy to panic and sell just to stop the bleeding.
Well, if you're holding high-price inventory, selling into a volatile bounce is incredibly risky. The price has already dropped significantly from those recent peaks, and as we discussed, there appears to be a very strong, algorithmically supported floor around $4,000.
So holding is better.
Unless your personal financial situation demands immediate liquidity, holding your position is the much safer play right now. And conversely, if you are sitting on cash reserves, you should be patiently looking to buy on the inevitable dips when the market pulls back, rather than chasing these sudden vertical spikes.
Let's pivot to silver for a moment, because the strategic approach our sources recommend for silver right now is fascinating. The data suggests that silver is currently a much better asset for surfing, meaning short-term trading, than gold.
It absolutely is right now.
The logic here is that silver moves in direct synchronization with gold, reacting to the exact same macroeconomic data, but it offers a much higher percentage profit margin on those swings. Plus, physical silver trading often doesn't suffer from the same steep buy and sell spreads that you encounter when trading physical gold. So if I'm interpreting these market dynamics correctly, if you are looking for a secure, relatively stable vehicle to park your wealth for the long haul, gold is the reliable family minivan. But if you are looking for a fast, volatile, short-term trade right now, silver is the sports car.
Silver is absolutely the sports car in this scenario. It accelerates much faster on the way up, giving traders those high profit margins. But remember, the physics of a sports car.
It can crash.
It crashes significantly harder on the way down. Anyone choosing to play the short-term surfing game with silver must employ incredibly strict risk management. Volatility cuts both ways.
Right.
If you're entering short-term trades without strict stop-loss protections in place, a sudden reversal in the dollar can take that silver sports car right off a cliff, taking your portfolio with it.
That is a vital warning to keep in mind before jumping into the deep end of the silver market. All right, let's pull all these threads together and concisely wrap up the key takeaways from this June 27th morning report. Gold and silver just experienced a spectacular, violent technical bounce.
Massive one.
This was entirely triggered by the United States personal consumption expenditures data simply meeting expectations rather than exceeding them. That lack of a negative surprise brought the dollar and bond yields down just a tiny fraction, which was all the excuse the institutional algorithms and eager bottom fishers needed to flood back into the market at the $4,000 floor.
It was a textbook relief rally. But as the Wall Street forecasts clearly show, the broader long-term market is still holding its breath. We are firmly stuck in a holding pattern, waiting on the Federal Reserve to make a definitive move regarding interest rate cuts.
Exactly. It is a waiting game. But before we sign off, we want to leave you with a final puzzle to ponder. Something that isn't really making the front page headlines today. We talked earlier about how Wall Street institutions are remaining cautious right now, largely because they are factoring in that unusually weak physical demand out of China. But consider the mechanics of what happens when trends shift.
This is the scenario that could upend all those conservative Wall Street models. What happens if that massive sleeping dragon of Chinese physical demand suddenly wakes up and returns to historical buying levels at the exact same time the Federal Reserve finally decides to cut interest rates?
Oh, wow.
You would suddenly have a massive global influx of retail buying colliding head-on with a tidal wave of institutional capital shifting back into zero-yield assets. That synchronized collision is the wild card that nobody on Wall Street seems to be pricing into their models right now.
What a thought. It would be like that rubber band we talked about getting pulled back on both ends simultaneously. When that level of tension snaps, the upward momentum could be genuinely historic. So we turn the question over to you. What do you think is coming next? Will gold shatter that $4,100 resistance ceiling next week, or is this massive jump just a technical fake out before we see another painful drop? Let us know your thoughts and your strategies in the comments below. And again, if you found value in this deep dive, please remember to hit like, subscribe, and ring that notification bell so you never miss our daily economic updates. Thank you so much for joining us for this in-depth market exploration. Stay disciplined, trust your strategies, and we hope you have a fantastic, profitable day.